Hello, everyone. How are you doing? Happy Saturday. Thank you so much for joining me. Welcome, welcome. All right. So how many of you have taken a class from me before, or how many of you is this your first class? You can just say, yes, I've taken a class, or this is my first class, or anything like that. Just helps give me a gauge. All right, awesome. So tons of people that it's their first class, tons of people that it's not their first class. Okay, awesome. Excellent. So I did, I know a lot of you also just took John's Ready and Fire class. So I did go ahead and put the Ready and Fire on my charts as well, and I will let you know kind of how I use that in addition to everything else that we're doing. So because I know a lot of you were asking about that. So if you have it, that's great. If you don't have it, don't worry. I just added that, just because I got a lot of questions on it. But we are going to go ahead and get started. This is going to be 262 slides, okay? And this class is different than all of the classes that I've previously taught. Because this is kind of a combination masterclass where we're covering a variety of setups and a variety of strategies. So just because of the fact that it's a cumulative class, there's going to be different ideas that are spread out throughout the presentation. And so if something doesn't make sense, I promise I'm going to go over it multiple times. We're also going to do a couple different just live demos on the live charts because we are covering a variety of setups. I just thought that would be easier that way. So if you're asking me a question and I don't get to it, that's most likely because I'm going to be, number one, taking questions at the end of specific sections. If I stop and take questions the entire time, we'll just never get through the presentation and it won't be in order. So please don't get too frustrated. I absolutely will take questions at the end of each section. You are going to have the slides. There's also a ton of homework in there as well. So I don't know if y'all have, let's see if I can go to it and just show you exactly where it is. So, and I'm happy to add anything else in here too. Number one, there's an indicator session from Duncan. So any problems that you have about how to install the indicator, or your Phoenix Finder isn't working, or anything like that, Duncan is a great person to ask about that. Working with all that stuff, I can try to answer your question, but Duncan and Daryl are really the best people with any technology problems. So asking them, you're probably going to get a better answer. And I definitely watch that if you haven't watched it yet. Now, I did also put a ton of different homework in here. There's only so much I can put into it. So what I usually do is I just add a ton of extra stuff in here. So you can check out more videos on butterflies. There's also videos on Fibonacci. There is a document in here that explains exactly how I set up my charts. And there's just more homework. And there should be the Options 101 class in here somewhere as well, but I think that was sent via email. There's also instructions on how I set up my watch list. So make sure you check out all of that, and that's also where I'm going to put the slides at the end of the class. We can also make a list of the other Phoenix folios you wanted me to add. You're right. Here, I'll write that down. You wanted me to add the futures one. Yeah, I can definitely add more of those as well, and I can add anything else that needs to be added. So, all right. So let's go ahead and get started. If you have any questions, especially about your account, your class, anything like that, please email support@simplertrading.com because I don't have visibility to all of that. But if you have a question pertaining to the actual class, then you can definitely email me at Danielle@simplertrading.com. So let's go ahead and get started. Welcome to the Options Freedom Formula. So when we're talking about options account growth, okay, growing an account, it requires a recipe. And that's why we're not just talking about one setup here, okay? When you're growing an account over time, you have to have recipes that work in various conditions, okay? And just keep in mind throughout this class that what I'm teaching you here today is my recipe, the way that I do it. So just like anything else, if I give 279 people a recipe for how to cook barbecue chicken, everybody's going to do it a little bit differently. Maybe somebody likes a little bit more salt, or somebody likes it to be a little bit more moist, whatever the case may be. So just keep in mind that this is my personal recipe, and if you want to tweak it, change it to whatever works for you, that's exactly the idea here. So, at Simpler in general, what we primarily do is trade options in a directional manner, okay? We make those picks based on a combination of technical and fundamental analysis, all right? Different types of trades are taken based off of different types of patterns, okay? So each one of those patterns is called a setup. That's like the most important concept, really, I think, in directional trading, or really any type of trading, is you have to be able to recognize specific patterns that are high probability setups. And we're going to go through tons of examples, okay? So for me in particular, I focus primarily on directional patterns. I also focus on relative strength, okay? So that's a core concept in this overall class. Basically, everything that I do has relative strength as the backbone, okay? I do use an overall macro view along with traditional top-down analysis. And then I also, really focus on identifying hot momentum moves. And this really isn't a part of traditional top-down analysis. But I focus on first top-down analysis, and then after that, looking on identifying hot momentum moves. And I use these strategies to both trade options and just build long-term stock accounts. So it's basically the basis of everything that I do. So with an options account growth recipe, these are the things that you need to have, okay? You need to have an idea of what you're looking for. You need to know what kind of growth you're looking for, what type of risk is acceptable to you. You need to know where to pick up your ingredients. You need to decide if you want some tried and true ingredients or take a risk with some new spice. You also need to determine how you want to mix it together, what kind of cooking method you prefer, and if there's going to be anything extra special in this, okay? Now, I've been using the cooking analogies because I think that it makes a lot of sense to people. I mean, I think pretty much everyone, even if you hate to cook, you have to cook to eat, right? So I think that when you break down trading like this, it makes a little bit more sense. So then that way you're not leaving out a key aspect, because what I find with so many people who email me who say, hey, I'm not sure what I'm doing wrong. I've been trading for 5 years and it's not working for me, and I don't know which step I'm missing. So normally I go through this exact formula with them to figure out which step you're leaving out. Because just like in cooking, if your ingredients are bad, is your dish going to be good? No. If you mix it together wrong, is it going to taste good? Probably not. And then if you might like to cook it one way or another. Some people like the oven, some people like the smoker. So I think it's a pretty good analogy, and just keep that in mind when you're going through trading. So for example, when I'm talking about what type of recipe you want, you have to know what kind of growth are you aiming for. Now, like I mentioned, when I first started out, I was looking for 20%, 50%. John always says never aim for more than 100% because it's just a good goal to have. But once you can get it up to 20% and then 50% and 100%, you should be able to do it multiple times. So just keep in mind what you're aiming for. Now, if you're relatively newer to trading, like I said, you don't want to just automatically aim for 600%. You want to have the idea that the growth is going to come over time and you get better and better over time. So let's say you first aim for 50%. And then once you achieve that, after that, you try to raise the bar a little bit. You get a little bit more aggressive, and then you try to aim for 75%. And then after that, let's say you aim for 100%, okay? And then once you get really good at it, you should be able to do it multiple times over. So you have to know which type of growth you're aiming for. Next, you have to know your main ingredients. The setup is the core. The setup is everything that I teach is teaching you a specific setup, okay? Like I said, this class is unique because I'm teaching you multiple setups. Typically when I teach a class, I do one setup for the full 4 hours, the ins and outs, every single which way you could look at it. But with an options account growth, you need to have multiple setups. So that's why we're doing multiple setups here today. Okay, now the setup is the core, right? Like you can't have a Thanksgiving dinner without turkey, right? But of course, you want some other portions on the side, okay? So you absolutely have to have your setup. And then there are going to be various sides that are give and take, but you have to have your main pattern, okay? You also need to know where to pick your ingredients, which is how are you gonna find those setups? You know, are you gonna go to Costco? Are you gonna go to HEB? Same thing in trading. Are you gonna use a scanner? Are you gonna use the Phoenix Finder? Are you gonna use a watch list? Something like that. So keep that in mind. Then this is really, really important. And I think this is a big thing that people get wrong. So when I first started trading, I was learning from John, and I would call the tickers that he trades the risky business trades. Okay. So you can either trade tickers that are going to be super volatile, they're going to move a lot, so, you know, like Tesla and space and Beyond Meat. These are tickers that I would call risky business, okay? And I love learning from John, and I love the fact that he trades those tickers, and I trade them now as well. But when I first started trading and I was first learning how to grow accounts, sticking with the regular runners is absolutely critical, okay? These are the Microsofts. Visa, I know Visa wasn't ideal this week, but Visa it's a ticker that doesn't normally move more than 2%, okay? So when I'm talking about a regular runner, I mean a nice large cap stock. It's heavily traded, usually doesn't move more than 2 or 3%. You can usually plan on it being in a nice trend, and it normally goes the direction that you want, but it's not going to do anything crazy, okay? You're not going to wake up on Monday and it's not going to be up 10%, but that's fine because it's a regular runner. It's a nice, easy trade. So this is something that a lot of people get wrong, because when they get into options trading, you know, they're enticed by the recent IPOs and whatever ticker they're talking about on CNBC. You really have to look at your setups, and then you have to know for yourself what is going to fit your risk parameters. So for me, when growing an account, in the beginning when I was starting out, I would do pretty much all regular runners. This is supposed to be a pie chart here. I would do pretty much all regular runners, and maybe I would have like one risky business stock on, okay? Well, over time, as you know, you get a little bit more aggressive and you try to push it a little bit harder. Then maybe half of your trades are the risky business and the other half are the regular runners. Okay? And you never, ever, ever want to have all of your trades as the risky business trades. This is a terrible plan. You know, whenever you see somebody in the options room saying like, hey, you know, I took $10,000 and I made $1 million. First of all, I don't know if that's, you know, you always want to question that, number one. But usually people who do stuff like that, they are putting 100% of their account into these crazy risky business stocks. And, you know, I'm sure they did a great job and everything like that, but there's no way you can get growth like that without pushing the pedal to the metal and trading these type of crazy volatile names. So for me, the way that I have done it with these accounts is I do not push the pedal to the metal with these type of risky business stocks. Usually I do about half. So I'll have, you know, half tickers that are maybe space or Tesla or something like that. And then the other half are tickers that are not going to be as volatile, okay? And for me, I usually don't go over about 50, try not to go over 60% of overall account allocation. We'll talk about that in a different section as well. But it is really important to think about the tickers that you're trading, because when you're growing an account, you do not want to wake up on a Monday morning and have, your entire portfolio of new IPOs and who knows what news comes out and the market's down 5%. So it's going to be very bad. So the next is going to be what type of cooking method, okay? I'm comparing the cooking method to the type of option strategy, because the setup is one piece of it. The setup and then the ticker, but after that, you have to decide what to do with it. Now, some people are going to like calls more because they want to put a little bit more risk on. It also depends on your account size. Some people are going to want to put on a more conservative put credit spread. Some people are going to want to put on a cheap fly so that they can take advantage of a directional setup and also have a debit on versus just selling premium. Or do you want to mix it all together? So during this class, we're going to talk about all three and then how we mix them together as well. Different setups call for different situations. And then you also want to determine what goes good together. So again, this class is a combination class. So we're going to be talking about short squeezes with regular squeezes, short squeezes with Phoenix. You just have to imagine, you're making a recipe and you want to think of complementary pieces that will go good together. And then, if there's going to be some extra butter or dessert, this is when you really make everything good. When you have a really, really nice combo of basically the best patterns that you can imagine. So here are just some examples of different stories that I hear all the time. So I use the name Mark. I don't know why. Mark. Here's Mark. He trades long calls. He's an aggressive trader and he likes the risky business stocks along with a few of the regular runners. He sees major account swings both up and down. He makes money, but he's not consistent. However, he does have huge winning days to go along with big losing days. He has an especially rough time whenever the market pulls back, probably because he had a ton of long calls on right near the highs, okay? I hear this story all the time. Now, when diagnosing the issue, the number one thing I always point out is that Mark needs to learn multi-leg option strategies to even out his ups and downs, okay? When you only have these risky stocks on and you only have long calls, the thing is that the way that they move can be pretty wild. So yeah, it's great when the market's going up, not so great when the market's going down. So if Mark would add some butterflies and some spreads, then when the market pulls back, he's not going to experience these huge moves up and down, but the curve is going to be a little bit more solid versus jagged like that. We want to try to get the curve as solid as we can. Now, don't ever imagine it's going to go directly straight. That's just not a reality. But you do want to make it as, you do want to even out those curves, okay? We don't want the jagged curve. Now, here's Patty. Patty likes to sell premium. She's not comfortable with a lot of risks, so she primarily sells put credit spreads. She doesn't like taking on the risk of long calls and isn't comfortable with adding butterflies. She makes decent income, which varies between 20 and 40% without a lot of risk. She doesn't experience big winning days, and she will occasionally have rough days when the market pulls back seemingly out of nowhere. However, due to her controlled risk, it isn't anything she can't manage. She could also benefit by adding the multi-leg option spreads along with learning how to do long calls at the right time. So when you're, just selling premium, you have something that looks a little bit more like this. Okay, so what you need to do is you need to learn how to add some more peaks in here to the upside curve. Because when you're just selling premium, it's just pretty much like a regular income stream. And then, of course, you're going to have some days where the market pulls back and you're going to lose money. And so your curve is going to fall a little bit down. But this is great. This is a great starting point. It's awesome. There's nothing wrong with 20%. There's nothing wrong with 40%. But if she can learn how to maximize how to trade directionally, because right now she's already got direction down, okay? If she's selling put credit spreads, that means that the market's going higher and she's making money, right? Well, now she needs to figure out how to add butterflies and calls to take advantage of those moves higher. So these are like two really, really typical stories that I get all the time. And it's a simplistic explanation, but really that's what we're going to be working on today. So here's the one that I guess I could have just called it me, but this is basically how I do things, okay? Peter uses a variety of setups along with strategies. He changes the setups he's looking at depending on what the market's doing. This is very critical, and we're going to go over this. Whenever the market changes, you have to change with the market. When the market's strong, he's more aggressive. When the market shifts, he becomes more conservative. While he primarily trades the trend, he has strategies to use during choppy times. You have to have different recipes. You know, sometimes you want chicken, sometimes you want steak. He makes most of his money during momentum markets, and while he will lose money when the market shifts, it's normal, he's overall pretty consistent and makes money on a regular basis. So the goal here is we want to be like Peter. So this is how we're going to do it. Here is the class outline. We're going to be talking about number one, hunting for honey badgers. These are going to be the stocks that do, you know, whatever they want, regardless of what the market is doing. They're the stocks that stick out. They're the momentum movers. We are going to be doing that by looking at Phoenix. We are going to be looking at scans, talk about resources that I use, and just a kind of basic overview of some macro and top-down analysis. We're also going to be having a section where we specifically cover the key definitions and key trading terms that I use. After that, we're going to be covering the top setups. These are going to be the patterns. We're going to talk about the magic combo, and then we're going to talk about the core trading strategies and when to use each. All right, so that was the introduction. I do want to go ahead and take some questions right now. And just so you know, I mean, this is where we're going. So a lot of these questions, so what is the difference between the squeeze and short squeeze? We are definitely going to cover that in this section. At some point, can you discuss setup choices looking at income percentage in the context of time? 20% gain over 150 days versus 10 days is a huge difference. Yeah, let me see how I can fit that in. Let me see how I can fit that in. Yeah, and it is also over the context of time, but it's also over the context of the market condition, because you're not going to be able to have massive account growth if the market condition is not getting along with you. So it usually only takes me, like I can double an account in 3 or 4 weeks if I want to, but the market condition has to be conducive to the setups. So the goal here is that you have to be able to identify the setups, and then when those setups appear, that's when you want to jump on them, because otherwise you don't know when you miss the opportunity. But yeah, we can talk about that. Yeah, like Snap the other day. Will there be things we need to learn outside of the class, since each setup can take 3 to 4 hours to learn? Yes, that's why I added extra homework, and I can absolutely add more homework as well if we need more questions. For the core strategies, can you please show us how to place stack profits? I took the stack profits course, but I don't know how to place the trades. Yes, we're going to be talking about that. Can you go over how to identify when the market shifts? Yes, we will be talking about that. All of the materials you will have forever. Once you buy a class, you have them all the time. I'd like to trade for income. Can you compare different trading styles and strategies to use? The Danielle version of the Carter 2.5% a week? Yes. Will you have time to go over earning strategies? Not during this presentation, but I will absolutely go over them during the live trading, because we're going to be in the middle of an earnings week. Can you make sure how to exit butterflies? Yes. How many positions do you typically have on at one time? I go up to 15, but it depends on the market condition. So for example, right now, I think I only have 5. But the market is setting up really big right now, so I'm going to start adding some more size in the next 2 weeks. Yes, I can cover. I can talk about the futures indexes as well. I'll see where I can add that, and I'm going to add the futures folio to the to the folder as well. All right, so let's go ahead and talk about hunting for honey badgers, okay? So we want to talk about where to look and how to identify them. This is the core idea in making money with options. Making money in the options market is not about identifying not just greater than expected moves, but you really want to be looking for big exponential movers that move on big volume, high momentum, and have relative strength in relation to other stocks in the market in their industry group. This was the biggest change that I made that allowed me to start making exponential gains on a regular basis. When I first started trading and I just used the squeeze and I just used the ready and fire, and I wasn't really paying attention to which kind of tickers I was trading, I did all right, and I sold put credit spreads, and it was fine. But the huge change that I made was learning how to identify relative strength and learning how to pick out the tickers that are moving bigger than the other ones in their group. Because what you always want is you always want the biggest mover, okay? You don't want something that's just going to be meandering around. You want the strongest one. So when we're talking about directional versus neutral, we can make money in either a directional or neutral market. Primarily, the trades that we're going to be talking about today are directional, but just keep in mind when you're using put credit spreads, even if your direction doesn't come through and you're trading flat, you can still make money in a neutral market with put credit spreads and unbalanced butterflies. But for exponential account growth, and I hate to say that, when saying that it's not income is not really accurate, but people usually refer to income trading as like 20% a year. So you can absolutely make income on exponential moves, and it's going to be better than, like a 20% a year or something like that. It's just not typically referred to as income trading because it's, I guess, more speculative and because it's directional. But what we're looking for in this directional trading is identifying points where price moves from A to B, okay? You got A right here, you have B here, and you're looking for this move. That is what you want to capitalize on. And strategies such as calls, spreads, and flies are really my go-to strategies for this type of market environment. So here are some key facts about options. They're absolutely priced so that you'll lose money if you do not know what you're doing. The key facts that I use are, number one, they lose money via theta decay over time. So when you buy an option, it's always going to lose value over time, okay? Because that's just what it does. You have your theta decay. So your goal when you're buying options is you have to do it in a way so that you're going to have enough time on your trade, and ideally the rise in price from point A to point B, along with your time, it's going to counteract your theta decay. You can also use this fact to your favor by buying butterflies or selling put credit spreads. This is also a very key fact. IV rises into earnings and key events like the election. The implied volatility of an option is a key component in how the option is priced, okay? So just like the theta is a key component as well, which is going down over time, the implied volatility can go up, it can go down, and that is also another key component. So right now, what we're grappling with is, number one, a major earnings quarter, okay? So IV is rising right now because next week and the week after we have a lot of earnings coming up. And it also rises around key events like the election. So right now, we're currently in a rising IV environment. Okay, so you just kind of have to have that in mind. And that's something that comes up every earnings quarter. Multi-leg option strategies are going to help traders control their risk, maximize their reward, pinpoint specific price targets, and most importantly, take advantage of these two facts, so that you're not getting taken advantage of. Options are going to move based on the underlying stock price, along with several of these key factors right here, okay? So it moves based on the stock price, moves based on the implied volatility, how far they are until options expiration. Delta is also the critical Greek. I don't get into all the Greeks except for delta and theta. Really, I just use it to help select strikes, okay? Because you want to know how much it'll move based on a change in the underlying stock. And these are really the key facts that I'm going to be using in this class. And we use these to our advantage, not our disadvantage, okay? So multi-leg strategies are so important because number one, you can knock the price down significantly. Especially when you're growing a small account, being able to knock the price down is absolutely critical. You can also control your risk, and you can also pinpoint your reward zone. So when you're going from A to B, you can use multi-leg option strategies to target B, okay? And the other reason why I like them is because they're not going to, you're not going to have these up, down, up, down, up, down. They're going to smooth out the curves here, smooth out the curves here, smooth out the curves here, smooth out the curves here. And we're going to get into that a lot more.